A very warm welcome to all my folks out there, those who are watching and those who are not watching. Anyways, doesn't matter. Peace and love to everyone. So finally, after making so many videos, I finally decided, 3 videos in total, I finally decided, yes, to make a video which you guys requested for on trading apps or brokers. And yes, this is the video, what you have been waiting for. So without further ado, let's check it out. So as you can see in the title of the presentation, it's trading platforms for Europeans. Yes, this video is going to be specially dedicated to my European viewers because I have been asked by many of my viewers who are non-Europeans living in Europe or Europeans as well. And sorry guys, I know some of my viewers are also from States and Canada, but I guess you guys already have a lot of tools and brokers out there which are really good, like Robinhood, Fidelity, TradeStation, and so on and so on. So I especially dedicated this video to the European viewers, and yes, this is a guide for beginners because the applications which I'm going to talk about are really user friendly, and according to me they are much more better designed for beginners or not so advanced traders. Yeah, of course advanced traders can also use them, but these are especially for beginners. So guys, before we go further and check our list of brokers, I would like to clarify one thing, that this list is not in any specific order. This is just random brokers from 1 to 4, and of course in the end of the video I will definitely give you a conclusion, so stay tuned till the end of the video, and yes, we will see the conclusion. Anyways, so let's check out our first broker on the list. So the first broker on the list is Comdirect. Now I have personally included this broker because I'm living in Germany, and I have seen many of the traders are using this broker as well. But anyways, let's see the points, all the points. So this is for Germans because the application is purely in German language and you cannot change the language. Because it's actually a German bank. So as the point 2 says, since it has a banking background. So it has a banking background, and that's why it is itself listed in the stock exchange. So it is as a stock listed in the stock exchange. Now, no account opening fee and no inactivity fee. So if you're going to open the account in Comdirect, you don't have to pay any fee. And also there is no inactivity fee. So what inactivity fee is, that means if you're not trading for a particular amount of time, let's say 1 year or so, then with some brokers you do have to pay a fee, and in this case you don't have to pay any fee. But actually I don't decide a broker just based on this one factor. Always check the overall performance of a broker. Okay, so let's move on to point 4, high trading fees for US, UK, and German stocks. And I think this is one of the important factors for all the brokers out there. So yes, there is a high trading fees. It is around 3.9 euros per trade when you are dealing in euros. So that means 3.9 euros when you are selling the stock and 3.9 euros when you're buying the stock. So it's not actually such a good app for intraday trading because you have to pay every time. And this is a good application or a broker when you're looking for long-term investments. And we will go further into this, especially when we reach point 8. Anyways, so point 5, Euro to USD benchmark fees is also high, but this is only when you are trading with Forex. Point 6, withdrawal time can take up to 3 days and bank transfer is also possible. Point 7, account opening needs personal ID or passport video identification and bank statement. So for every broker you would need a personal identification and a proof of residence. So every broker will need that, but this can take up to 3 days. Okay, so your depot account will open within 3 to 4 days, let's say. So point 8, the market and the product availability is excellent in Comdirect, and this is one of the reasons why I have included this in our list. So what I mean by this is, for example, when you're looking for ETFs, Comdirect has around 1,000 ETFs in its portfolio, and this makes Comdirect a versatile application when it comes to its portfolio, and that's why I like its portfolio. But again, if you're not speaking German, if you're not a German speaker, then this might not be the best choice for you guys. So demo account is possible. Now demo account is one of the most important things which I would recommend for any beginner who is entering investment or trading world. What is a demo account? A demo account gives you a possibility to play with fake money. That means it's a simulator and you get amount of money, like let's say 500 to 1000 euros or something like that. And you can do, or you can start trading and practice your trading and increase your learning curve. And that's why demo account is a really important feature when you are a sole beginner. Okay, let's move on to point 10. Investment protection amount is up to 100,000 euros, and for 20,000 security, for example, when you are going into long-term investments like bonds or ETFs. Now, what exactly investment protection amount means? So investment protection means that every bank or every broker will give you a certain limit, let's say up to 20,000 euros or dollars in case of, which is a common figure in case of every broker. And in case the broker goes bankrupt, then this money you will get, this amount of money you will get back for sure. So this is like an insurance. So let's come on to our second broker on the list, which is DEGIRO. The first point is no account fee, no inactivity fee, and no withdrawal fee. So when you're going to open an account, there is no fee for that when you're going to open it, and there is no inactivity fee as well. That means when your account is stagnant, you don't have to pay any fee for that. And then there is no withdrawal fees. So what is withdrawal fees? So when your money is sitting in a bank account, in your own bank account, in the savings account, then if you want to withdraw the money, it just reduces your bank balance by the amount of cash you took out, or you did a online transfer. It's as simple as that. But when your money is sitting in a brokerage account, and when you want to withdraw this money, then the broker have to do this transaction by either send to your bank account via electronic funds transfer, or arranging for a wire transfer. And that's why most brokers charge fees for these wire transfers, which are faster than standard electronic fund transfer. And this is the reason why they are charging extra money, because they are sending the money through another means to your bank account, and which are, so it's not directly linked with your bank, and that's why they charge fees for this extra work. Now it also says that if you have a good broker, then it should not charge this withdrawal fees, but I don't agree completely with this, because some brokers are really good brokers and they do charge this withdrawal fee, and it's not as big as you are imagining. So don't just judge a broker by this one fee. Like I said, always check the broker's overall performance. Now coming back to point 2, which is quite important for the traders out there, stock fees. Yes, DEGIRO do charge the fees on buying and selling the stocks. As you can see, you can pause the screen and you can see the price. But I still see that the price is not so high as compared to its other competitors in the market. DEGIRO is really economical, and it has no benchmark fees for forex traders. Now point 3, withdrawal time is 1 day. Now withdrawal time is quite quick, and this is the quickest you can find on from any of the other trading platforms or brokers. Account opening time can take up to 3 days, and this is one of the drawbacks which I find in DEGIRO, that you will be waiting in a queue for opening your account. And of course, the account opening needs proof of identity and proof of residence. Like I said, it's common for all the apps. But yes, this is one of the drawbacks, that it can take up to 3 days to open your depot account. Now, no minimum deposit is needed. This is a really good feature of DEGIRO, that when your depot account is opened, you can instantly start trading without depositing any money. Okay, so this is a really good feature of DEGIRO. Now point 6, it's a really good mobile app and it's really user friendly. Trust me on this. The user interface is really nice and it's easy to understand for beginners as well. Point 7, statistical analysis is quite good. Now what I mean by statistical analysis, so this is an example of DAX 30, which is a German index, and you can see here the companies which is included in this index, and you can easily see all the other statistics, and the chart is really easy to understand and it's really user friendly. And the next point, which concludes to point 7, is good tutorial videos. It really has good tutorial videos which will allow you to learn more about the application, how to use it, how to use the interface, and actually not just that, but also the tutorial videos on investment strategies as a beginner. So let's come to point 9, wide range of portfolios, especially for stocks and ETFs. So it also has a wide range of portfolios, especially for stocks and ETFs like Comdirect, but not for Forex and CFD trading. So you cannot do Forex and CFD trading, but anyways, I am not a big fan of Forex and CFD trading anyways. And especially when you're a beginner, you should really not look into this. Now let's come to point 10. The biggest drawback for beginners is that it has no demo account, and I personally don't understand why DeGiro has not thought of putting a demo account. Okay, anyways, coming to point 11, another big drawback for non-German speakers in Germany is that language change is not possible. Yes, if you are in Germany and if you downloaded the app with Germany as your country of living, then you will get the app in German language and the language change is not possible. So same like Comdirect, this comes with the common drawback, and I think they should really change this feature because to be honest, DeGiro is coming with 15 other languages, and I don't understand why in Germany you don't have the possibility to change the language. Okay, so coming to point 12, investment protection amount is up to 20,000 euros like other applications, like other brokers as well. And now coming to our third broker on our list, which is Trading 212. So let's quickly check the points. The first point, no account fee, no inactivity fee, and no withdrawal fees at all. So no fees in this structure. And second point, yes, it is the most attractive part of Trading 212 that it has no stock and ETF fees. You don't have to pay anything when you're trading with one of the stock markets of doesn't matter US stock, UK stock, or German stock. And because of that, you might have to buy a minimum amount of stocks. So this is not a drawback. I would not say it's a major drawback. For example, if you are trying to buy a stock, let's say for 10 euros or $10, then Trading 212 might ask you to buy a minimum of 2 or 3, because of course since there is no fee and no fee on trading, so just not to lose money on that, they will ask you to buy at least a minimum amount of stocks. I will not go into much more details for benchmark fees because this is for Forex trading, and I don't recommend Forex trading anyways when you are a beginner. Point 4, withdrawal time can take up to 2 days depending on the verification. This is for actually the security of the traders, and it can take up to 2 days. This is not a major drawback, I would say, because I always recommend that when you are putting money into investment, you should put that amount of money which you won't be needing anytime soon. So please make sure that you have an emergency saving fund which is ready to use whenever you want, and don't take out the money which you have invested because you can go in huge loss. So anyways, I don't recommend to put all of your savings into investments. So this right here is not a major drawback for me and shouldn't be for you as well. Point 5, time to open the account in 1 day and minimum deposit is $1. Yes, it needs 1 day, which is really good. And minimum deposit is $1. Like DeGiro, you don't need almost any deposit and you can start trading instantly. Point 6, proof of identity and proof of address will be needed. Like I said before, that for every app, this will be common. 7, this is one of the major drawbacks of Trading 212, and the only one which I see is the stock portfolio is actually limited. So the stock portfolio is not that huge, but honestly guys, if you're a beginner or not an advanced trader, you don't need a huge stock portfolio. The most important ones, or let's say the most big industries, are already there, and actually they are adding or increasing their portfolio every day because they themselves know that the portfolio is not that big of a positive point for them. Anyways, and no fund bond investment is possible. Yes, so Trading 212 is practically good for trading with CFD actually, and if you're looking for intraday trading, but this is not the best choice if you're looking for long-term investments, especially for ETFs as well, because the portfolio for ETF for Trading 212 is also really limited. Coming to point 8, good mobile app and user-friendly. Yes, it's really user-friendly and it has a really simple user interface to understand. Good starting tutorial videos. Like DeGiro, it also have really good tutorial videos which will help you to understand the application and how it works. Statistical analysis is quite good. Same like DeGiro, it also have nice user-friendly charts. Point 11, demo account is possible and some good trading educational videos. So demo account is possible as well with Trading 212, which is a benefit, and some good trading educational videos are also there, so you can really train yourself and you can increase your learning curve with that. Another positive point, if we compare this with Degiro, language change is possible. So unlike Degiro, here you can change the language as well. The last point, investment protection amount is up to 20,000 euros, which, like I said, it's common to all the applications. So coming to our last broker on the list, which is eToro. So let's see what the points are. First point, no account fee, and there is inactivity fee. So there is an inactivity fee, which is around $10 per month after 1 year of inactivity. So if you're not using your account, your trading account for a year, then you would have to pay $10 per month. And there's also a withdrawal fee, which is $5. Now, I'm not judging this broker based on these two fees because it's not so high, but yes, I will not recommend this as an intraday trading broker. So coming to point 2, no stock fees, but high currency exchange conversion fees. Yes, the fees is not there. That means if you're trading, buying or selling a stock, there is no fee for that. There is no broker commission for that. But the exchange currency fees is there. That means if you have put your money in euros and you're buying the stock in dollars, then you would have to pay an exchange conversion fees. But honestly, this fees actually doesn't affect you so much if you're until you're trading in thousands of euros, let's say for 10,000 or 10,000 euros. Coming to point 3, withdrawal time is up from 1 to 2 days. Now, like I said, 1 day is the quickest you can get from any trading platform. So here in eToro, it can take up to 2 days. Point 4, account opening time is 1 day, and it's really easy as compared to other two apps. And as usual, account opening needs proof of identity and proof of residence. Point 5, minimum deposit is $200 or around 180 euros. Now, unlike Trading 212 and Degiro, you would need a minimum deposit of 180 euros in our case in Europe. Good mobile app and user friendly. Yes, it's really user friendly and it's a good application. The user interface is not so complicated, but the statistical analysis is just okay and it can be improved. It's not as good as the chart analysis of Trading 212 and Degiro. Point 8, wide range of portfolios, especially for stocks and ETFs. This is one of a really good application or a broker if you're uh, thinking of using it as a long term. And this broker also has a huge portfolio of ETFs. Number 9, demo account is possible. Now, in this case, also it's a plus point that the demo account is possible, but it also comes with another positive point, which is actually you can use and follow or copy other successful investors. Now, like I said, positive point, but only it's positive when you are using this feature during your demo account trial. Why? Because sometimes it's just my opinion, because sometimes you might copy a successful investor who was successful in last 5 or 6 months, and maybe he started in last 5 and 6 months, and he might be having a beginner's luck or just being lucky, and you saw, oh my god, he earned so much of money, so let me copy his account. And then you see a downfall, and because you just blindly copied his account. So it can be quite dangerous as well. And I say this because, guys, at the end of the day, you and only you are solely responsible for your own money. So trust yourself, trust your money. Okay, you can use this feature when you are in a demo account, when you are using the account as a simulator, when you're using fake money. And this actually can help you to learn as well that how the other investors are performing, how they are investing, what are their investment strategies. So you can follow them, but use this when you are in demo account mode. Point 10, you have the possibility to copy successful traders, like I said, but according to me, I don't take this as a complete advantage. And last but not the least, investment protection amount is up to 20,000 euros. So those were the brokers which I would recommend for the beginners or not so advanced traders. Of course, the advanced traders can also use them, but for much more experienced traders, I would say that these are the 3 brokers which I have filtered out, because they have great tools which actually experienced traders can really use to up their game. And that brings us to our conclusion. So in case of DeGiro, according to the analysis, this is the best application if you're looking forward to buy and hold your investments like ETFs and stocks for a longer time. Trading 212 good for beginners and CFD users. So I would say that this is much of a trading app, like the name also says, Trading 212. So this is not the best when you want to keep your money for a longer time. So let's say in investment, from an investment point of view, and it's a really good mobile app as well. eToro, good trading tool, especially as a social platform to learn trading. Also good for cryptos and ETFs because it has a good portfolio of ETFs. And Comdirect, if you're a German speaker, then you have the possibility to use this as a good investor. Okay, guys, so if that conclusion was not so user-friendly or clear, then I would conclude this in another way. Let's say if I would be going in for daily trading, intraday trading, then I would rank these apps in this manner. So the first one would be Trading 212. The second one would be DeGiro. The third one would be Toro, and the fourth one would be Comdirect. And from the investment point of view, I would rank them the following. First would be DeGiro, second would be eToro, third would be Trade 212, and fourth would be Comdirect. Now, I didn't put Comdirect in the first two positions, though it has a really good portfolio for long-term investments. But since here we are talking about European users and Comdirect is available, or it's much more beneficial for only German speakers, that's why I have put this at the last. So guys, that's it for today, and I really hope and I wish that this was really easy to understand for you guys, and I also hope that this helped you or will help you to choose your broker which you have been looking for. And if you really like the video, please don't forget, or please don't hesitate to push that like button, because it will really help me, and it will help me and motivate me to make more of such content. Yeah, this was the first step that you would need to start investing. Also, if you think that the voice quality was not so good, which one of my viewers already told me, and I'm really trying to work on it. I don't have my microphone yet, and I have ordered it, but it hasn't arrived yet. But I hope the information was crystal clear. And if you have any questions, please leave it in the comment below, and I would like to know your opinion on the apps which I mentioned. And yes, don't forget to hit that subscribe button. It will also help me. And till then, keep investing, be safe, stay happy, love and peace. Ciao. A very warm welcome back to my channel, guys. First of all, I would like to apologize, as many of you have been requesting me to make a video on beginner's guide on how to start investing, how to open a deeper account. And actually today's video was supposed to be that, but I recently stumbled upon a stock which actually one of my friend told me to have a look at this stock. And I thought, okay, let's dig deeper into this stock and let's check what is it about. And I think I found a gem. Yes, guys, I really think that this stock has a huge potential and a huge rate of return. But these are just my speculations, my calculations, which I calculated with the numbers which were present at this moment of time. So again, guys, please do your own research. And yes, I personally do think that this stock might have a huge potential. But anyways, let's not waste too much of time on this. And let's see, what is this about? So to understand what is actually happening here, let's have a short introduction or short overview about the two companies which we are going to talk about. The first one is VectorIQ. Now, what VectorIQ actually is? So VectorIQ is an acquisition corporation. What it actually means? That means VectorIQ went public under a special purpose acquisition company, which means that it went public just with the sole purpose to raise the capital and assets to acquire other companies. So you see, it does not have any significant operations. The company intends to merge and capital stock exchange, asset acquisition, stock purchase, or similar businesses combination with one or more businesses. That means it's a holding company, and it is just raising the capital and assets to acquire other company or to help the startups to boom. The company went public. Now what I mean by went public is that the investors can actually buy the stocks, so it's available for the public for investment. So it went public under 2018, and in this case it is going to merge with Nikola Motors. So what is Nikola Motor Company, what they are doing? So Nikola Motor Company is an American hybrid truck design company, and that's the reason why we are saying that Nikola Motor is a direct Tesla competitor.
and it also has a research and development operations which in Arizona, and was founded in 2012. So here you can see the portfolio of Nikola Motor Company, and they are a pioneer in electric heavy duty applications. So they will be for now dealing with heavy duty applications like pickup trucks or semi trucks or trucks, and they offer both electric and also hydrogen electric powertrains to cover class 8 transportation. So that's Nikola, and that's why they are a direct competitor of Tesla in field of electric and hydrogen electric powertrains applications. So now, since we have a short introduction or an overview about both the companies, now let's see what's going to happen soon, why there is a hype about this company. So Nikola, the US maker of heavy-duty trucks, which we already saw with batteries and hydrogen fuel cells, has become a Nasdaq-listed company. Now, what does that mean? That it was not a publicly available trading company. So for you guys who doesn't know what Nasdaq is, so Nasdaq is a stock market index which is along with Dow Jones Industrial Average and S&P 500. It is one of the most of the three most followed indices in US stock markets, and these are some of the companies which are actually listed in Nasdaq, like Apple, Microsoft, Nvidia, and so on and so on. So usually if a company wants to go public, they actually has to go through a common approach which is called initial public offering. And for example, like its competitor Tesla also did the same, but in this case, just to get a quick entry into the stock market, what they did, that they just made it possible via a merger with an already as listed company VectoIQ Acquisition Corporation. So they got a quick entry into the market by merging with VectoIQ. And after the completion of the merger in the second quarter of 2020, the new company will be called Nikola Corporation and will trade on the Nasdaq under the ticker symbol NKLA. And thus, after this merge is completed, the new company will be worth of $3.3 billion. And remember this number, we will see further as well, but keep this number in mind because this will help us to calculate some future numbers and our return on investment. So before we jump into the speculative analysis of this company's success in Europe, I would like to point out one more important thing to you guys, which is, okay, for me, it is quite important and attractive, is this guy, Steve Girsky. Please don't misunderstand me, attractive, I didn't mean in some other sense. And for the guys out there who doesn't know about him, Steve Girsky was the former vice chairman of General Motors. Also, he served as the chairman of Adam Opel AG Supervisory Board and was president of GM Europe for a period of time. So this guy has more than 30 years of working experience and he's very well acquainted with automobile and automotive industry, and that's why I trust him. And if he has seen some potential in Nikola Motors, then probably Nikola Motors do have a huge potential. Now let's see why this business has a huge potential in Europe. As you guys have been seeing that in the news feed, that Europe is now concentrating on clean mobility and alternative technologies for reducing the greenhouse gas emissions. So as you see in this article, in Europe, the road transportation is responsible for almost 20% of total greenhouse gas emissions, and the European Commission introduced the Clean Mobility Package in 2017. And that's when the hydrogen fuel technology comes into play. Now, this is a roadmap presented by FCHJU. So just a short introduction about FCHJU. So FCHJU, the fuel cells and hydrogen, it stands for the Fuel Cells and Hydrogen Joint Undertaking, and is a unique public private partnership which supports the research and development activities in fuel cell and hydrogen energy technology. So the objective of FCHJU is to bring these benefits to Europe. So coming back to the report presented by them, is it says that hydrogen could provide up to 24% of the total energy demand, or up to 2,250 tetrawatt hour, which is a unit of energy, in the EU by 2050. That's huge. And that means by 2050, hydrogen could generate 1/4 of the EU's total energy demand. So these are the numbers which are showing the number of automobiles out there in Europe which will be hydrogen fueled. And since we are talking about Nikola Motors, who are just producing trucks for now, 1.7 million of trucks would be running on hydrogen fuel technology. Now, the other reason why I think that this business is really well supported is because it has managed to bring good investors and strong ones. So one of the biggest investor in Nikola Motors will be CNH Industrial, which are also parent of Iveco Trucks, which was a huge success. And if you check the balance sheet statement of CNH Industrial, it looks really good. Uh, they have managed to collect $250 million from CNH Industries, and the other strong investors are Bosch and Hanwha Group. And Bosch, since you already know, I don't think I need to talk about Bosch. So they have accumulated a whooping amount of 230 million combined. So this is what tells me that this business is really well supported by huge investors, and they are in themselves really strong companies with good base and balance sheets. Okay, so now comes the most interesting part, I guess, for most of you guys and for me for sure, because this is what tells me that this company might have a huge potential and a huge return on investment. So let's check. So Nikola Corporation boasts that so far it collected more than 14,000 pre-order for its trucks already, which represents more than $10 billion potential revenue. So just imagine this is the potential revenue based on these pre-orders. Guys, these are the pre-orders. That means they have to produce these trucks, and this is the future potential revenue, which might be converted into real revenue. Anyways, so remember this number. So now let's check another important number, which is right here. The transaction reflects an implied enterprise value at closing of $3.3 billion. Now, what they actually mean by this is that when Nikola Corporation and Vecto-IQ will merge, which was planned to be happening in June, the new company will have a market or an enterprise value of $3.3 billion, which actually I still think that it is quite low if it is considered to be a direct competitor of Tesla. But anyways, let's still take this number. And yeah, so guys, this was supposed to happen in June, but now I am not sure. I didn't have any new news on this, that if it's really going to happen in June because of this pandemic. But anyways, let's consider this latest news what we have. So $3.3 billion. So remember these two numbers: 3.3 billion enterprise value and 10 billion potential revenue. So let's do some maths. So here we are. So the current market cap is $605 million, which I took from the Yahoo Finance of Vecto IQ. If you can just have a look. So here 605, and the future revenue, which we already saw, $10 billion. And by this we can calculate the future earnings. So usually the formula is revenue into margin gives us earnings. So now I googled up the average gross margin for an automotive industry is around 17%. And this is neither good neither bad. This is not the best case scenario, of course, because personally I think that this might be higher, but we don't know. Since this is a speculation, we actually don't know how they will be dealing with their operating costs. So in this case, if we take 17%, we get $1.7 billion of future earnings. Now, if you compare the earnings right now of VTIQ, it's around $8.8 million. And since we have seen in the article that future market cap after the merge will be around $3.3 billion. So let's imagine that the market capitalization would be around $3.3 billion as well, though it is really small as compared to Tesla. If we are considering this as a direct competitor of Tesla, Tesla right now has a market cap of $150 billion. So I think this is not a justified market capital from my side for Nikola Motors, but we are just considering this as a speculative number. This might be really high, but still with this number, just see the result and this will blow our mind. So considering the future market cap and the current market cap, which is around $605 million, we can get a return of 545% on this stock investment. Now guys, again, this is just a speculative calculation, but I'm calculating this with the numbers which are already there. And okay, maybe I will not get a 545% return on my investment, but I personally will be happy even with 100% return or even 50% return. And to be honest, this might even be higher than this. So this is what I think that this can happen with this company, and the returns can be huge. But again, this is just my point of view. It's not an advice. This is what I think can happen.
And that's all, guys. That was all the analysis what I could do. Yes, I didn't see the fundamentals of the company. I did the research of the company, what they're about, but not the balance sheets or the income statements, because I personally could not find a reliable source of balance sheet or income statements, because only, as you know, that only Vector IQ is there at Yahoo Finance. So I could only check Vector IQ, but also the Yahoo Finance numbers didn't seem to be so promising to me, so I didn't include them. So instead, I just took the future numbers and I did my own analysis and my own research and my own thesis on this. And that's what I already showed you. So coming back to my opinion, would I be buying this stock? Yes, personally, I would be buying this stock because I think that this has a huge potential. But like I said many times, this is a speculation. And remember, guys, whenever you are investing according to a speculation and not a proper investment, you should be ready to lose the money. So invest only the money which you're ready to lose. So I personally invested around 500 euros when the price was $18. And yeah, that's just me. Again, guys, this is not a financial advice. Please take care of your money. And that's it, guys. And I really promise I would make a video soon on a beginner's guide and how to invest and what depot account you should choose or how to open a depot account. Till then, please take care of yourself, keep investing, and ciao. Hey ladies and gentlemen, welcome back to my channel once again. And first of all, I would really like to thank all of you guys out there who have been supporting this small channel of mine with baby steps, and the channel is moving ahead in small and steady steps, which I really appreciate. I don't expect an unrealistic growth, and this is enough for me. The love which you are giving me, please keep throwing back this love at me. I really need it and I appreciate this. And I'm sorry for this gap between my previous video and this video because I'm a working class guy, and since the world is opening back, so I was busy with my normal schedule. I work from 8 to 5, but I love my work, so that's why I had been busy with my work. And I hope that you guys are enjoying your last days of freedom from your offices or from your schools. No, I'm just kidding. I hope you love your work, and the students out there who are going to universities, my viewers, cherish these moments because these moments you will remember for the rest of your life. Anyway, so jokes apart, serious face on. Today we'll be talking about 6 companies. These are oil producing companies and there's a lot to talk. So let's just straight hop into it.
Okay, so before we dive into much deeper fundamental analysis, looking at the financials of and talking about the 6 oil companies in this video, first let's see the general picture or the general overview of what actually has happened and what is going to happen in the near future according to the analysts and the data out there. So like you guys know, oil is a commodity, and being a commodity, it tends to see larger fluctuations in the price than more stable investments such as stocks and bonds. So there are several factors which influences the oil prices, and we will outline those factors. But just to have an overview right here, as you see, the price per barrel of oil went around $150 in 2008. Then it was fluctuating, it went down again to $45 or so, $35 or so, and then 2012, 2016, and 2018, 2020, it has come down to $25. Actually, it also went in negative. And as the news says, that oil prices has collapsed to its all-time low in 18 years. So this is the current situation of the oil. So the reduction in the oil price, or let's say the problem with the oil price, had been going on since years. It's not just at this time. Yes, at this time it became all-time low. But why I'm saying this? Okay, I will explain this after I explain the following article. So on March 5th, OPEC proposed a 1.5 MBD production cut. Now MBD is just a unit to measure the oil produced in terms of barrels. MBD is megabaud, and it's equal to 1000 KBD, kilobaud, that means 1000 barrels per day. So they proposed a 1.5 MBD production cut for the second quarter of 2020, out of which 1 MBD would have come from OPEC countries and 0.5 MBD from the non-OPEC countries. And the following day, Russia rejected the proposal. So Russia belongs to the non-OPEC group, which actually, let's say, made Saudi Arabia angry, which is the largest oil exporter and belongs to the OPEC group, and it boosted the production to 12.3 MBD. Now Saudi Arabia could really afford that because the production cost for oil in Saudi Arabia is the lowest, and that's why Saudi Arabia did it, and that resulted in a hit to the oil price, and it came down to $31.1 per barrel on 8th of March. Now, like I said before, that this problem had been going on since years. This tension between these two groups had been going on since years, and this might lead to the increase in oil price slowly. So in my opinion, the oil price would not spike up even after this current situation will get stabilized. It might take time until these two groups are agreeing upon a mutual decision to control the excess oil supply. So as you can see, these two factors, one on top of other, made the oil price go even in negative in March. So in this situation, the companies and the exporters will survive, which have buffers, and a recession will contribute for sure to high levels of public debt. So this point you have to remember when we will be evaluating the companies. So these two factors will highly influence our analysis. So here are the points which I summarized what we already discussed. And the first point, as says, responsive to decisions about output made by OPEC, because since we saw that OPEC is one of the most influential group because the production from the OPEC countries are much larger as compared to non-OPEC. The second point says the laws of supply and demand influence prices. In this case, the demand was heavily reduced because of this current situation. And the natural disaster which we already have in this case is this pandemic, and the production cost influence prices. Of course, the production cost is also really important because many of the countries would be producing at a bigger loss because of the reduction in the price of oil per barrel. So with this, we have outlined the factors which have influenced the oil price recently or even in the past, and which might influence the oil price, of course, in the coming few months, even after the situation is stabilized. Now we can finally move on to our financial analysis. And here we are on our spreadsheet. So the 6 companies which we will be talking about today are Chevron with ticker symbol CVX, ExxonMobil, XOM, Royal Dutch Shell RDSA, ConocoPhillips COP, Pembina Pipeline PBA, and Imperial Oil IMOTO. So we will discuss everything what we have been discussing in my previous videos. So we will go through all the financials, but I have just jotted down the main numbers. We will not go through every number, so the main numbers which will help you also to understand how this is affecting these companies. And after reviewing all the numbers and the financial details, we will decide which company would be the best buy, valuable or risky, and we will rank these companies in that particular order. So let's get started. So first, let's start with the summary. All this data is from Yahoo Finance, just for information. So price for Chevron at the time when I was making the video was $90.28 US, ExxonMobil 41.49 euros, Royal Dutch Shell RDSA ticker symbol 32.24 US dollars, ConocoPhillips 43.28, Pembina 25.11, and Imperial Oil 21.31 Canadian dollars. The market capital, which is worth noticing because this will help us to make our decision as well. Chevron is 168 billion US dollars, ExxonMobil is 175.074, Royal Dutch is 121 billion US dollars, ConocoPhillips is 46.415, sorry, and Pembina Pipeline 13.93, and Imperial Oil 15.643 billion dollars. So if you can see here, Pembina Pipeline is the smallest amongst all with the market capital of 13.93, and then it's Imperial Oil. So there is not much big difference, and these are the smallest amongst the giants. Okay, so now let's start the financial analysis with the income statement group. So like I said, all of this data is from Yahoo Finance. Total revenue for Chevron is 135 billion, ExxonMobil 249 billion, the Royal Dutch 321, so this is the biggest amongst all, and ConocoPhillips 29.575 billion, Pembina 6.9 billion, and Imperial Oil 30.836 billion. So if you see the market cap of Imperial Oil and Pembina is there is not so much big difference, but there is a huge difference between the total revenue of the two. So Imperial Oil is having much more bigger revenue, even bigger than ConocoPhillips, as you can see here. Okay, so gross profit is 30 billion, 51 billion, 28 billion, 7 billion, 2.04 billion, and 2.374 billion. So gross profit is the same range if we compare these two small companies. And operating income for Chevron, it's a negative. By the way, this data is trailing 12 months, not 2019. So this is from the first quarter of 2020. There is a big difference between 2019 quarter 4 details and data and between quarter 1 2020, because of the March tension what we saw, the prices were dropped, and that has resulted in bad margins, or let's say reduce in their gross profit and income. Then let's move on to our two more important margins. So gross margin for Chevron is 22%, ExxonMobil 21%, Royal Dutch 9%, ConocoPhillips 26%, Pembina Pipeline 29%, and Imperial Oil 8%. Now, gross profit margin is huge for Pembina Pipeline. What it means, so in simple language, it's the company's net sale, not the gross, the net sale minus the cost of the goods sold. Simple as that. Okay, so as we can see here, 29% for Pembina is huge. 26% for ConocoPhillips is also good. So anything above 20% is actually really good. And we can see here the most of the companies are above 20%. Imperial Oil and Royal Dutch Shell are below 10%, which is not so good. Anyway, so let's move on to the operating margin. So operating margin simply means that the company, how much the company is converting its revenue into profit. And bigger the operating margin, the bigger room for error the company has. So that means the company can really experiment before a profitable business turns into an unprofitable business. So operating margin here for Chevron is minus 0.4%, which is really bad, to be honest. ExxonMobil is 4%, Royal Dutch is 5%, ConocoPhillips is 20%, Pembina Pipeline is 25%, and Imperial Oil is 5%. So ConocoPhillips and Pembina Pipeline are amazing, and this is one of the really good things about these two companies. But let's go further and let's see if it's really worth. So the net income is 3.8 billion for Chevron, ExxonMobil 11.38 billion, the Royal Dutch 9.8 billion, ConocoPhillips 3.6 billion, Pembina 1.4 billion, and Imperial Oil 1.71 billion. Okay, so now let's check the balance sheet. In the balance sheet, the first line what we always see is the cash. How much the cash the company is holding, because this is quite important number to look at. That means this is the amount which the company can immediately liquidify in order to pay its debt. And also this number is important because if you see that the company is paying huge dividends, more than the amount of cash the company has, then you should be knowing this, that the company sooner or later will have to cut on its dividends or completely stop the dividends, because it's impossible for the company to pay off its dividends when the cash is much lower. The actual cash position of the company is much lower. So these numbers, guys, are really important to notice, because as we just saw before, that at this time, to weather this storm, the companies who are financially strong and stable can only survive. So that's why we are concentrating on these numbers quite heavily, especially for oil industry. We should also see, actually we should see for every industry out there, but at this particular moment of time, in these 6 months or coming, for the whole year, these are the most important things to have a look at for any company which is heavily hit by the current scenario. Okay, so let's go further. Let's check the total current assets. The total current assets and total current liabilities at this moment of time is quite important, like I said, because these are the assets which they can liquidify in the coming 12 months, and the coming 12 months are actually really quite important. And the current liabilities are the liabilities which they have to pay off in the coming 12 months time, and this is the time actually which will be difficult for them to survive. So the total current assets for Chevron is around 28 billion, ExxonMobil 50 billion, Royal Dutch 92 billion. That's huge, that's good, but it's also a bigger company, so that's why it has a huge amount of assets, but it's good. ConocoPhillips 16 billion, Pembina 987 million, and Imperial Oil 6.32 billion. Now, like we saw here, these two companies are almost having the similar market cap, though Pembina is stronger in its margins. But as you can see here that the current assets is huge. Now guys, margin can be also influenced by the debt. So if the company is taking huge debt and increasing its capital, then it also helps, or it also influences the margin. So this could be the reason. I'm not sure, but this could be the reason. So let's see. But operating margin is good. That's a really good thing. So operating margin is absolutely, it should be considered for sure for any company. Anyways, so total assets are the total assets including long-term assets. So 237 billion is for Chevron, 362 billion for ExxonMobil, 404 billion for Royal Dutch. This is good. ConocoPhillips 70 billion, Pembina Pipeline 33 billion, and Imperial Oil 42 billion. Now total current liabilities 26.53 billion for Chevron, ExxonMobil 63, Royal Dutch 79 billion, ConocoPhillips 7 billion, Pembina Pipeline 1.4 billion, and Imperial Oil 4.5 billion. So let's move on to the total liabilities, including so this is the total liabilities that have been short plus long-term liabilities, and that's around 92 billion for Chevron, 163 billion for ExxonMobil, 213 billion for Royal Dutch, ConocoPhillips 35 billion, Pembina Pipeline 16 billion, and Imperial Oil 17 billion. Now, don't just get affected by the numbers, because at the end you have to just see the ratio, which we will see right now. And this ratio, total assets versus total liabilities, will tell us if the companies can survive or not. So it's really good to see these numbers for all the companies. It's quite good and it's quite stable. If we compare this with the airline industry, this is the oil industry is in a much better shape when it comes to financial stability, considering the assets and liabilities. So for Chevron, the ratio is 2.57. So this ratio above 1 means that if the company has to pay all of its liabilities by selling its total assets, after paying off its liabilities, it will still be left with some assets. And the ratio above 1, of course, means that it's good, and it is considered to be let's say a stable company. So these two companies in the first column are above 2. So that means after paying all of its liabilities 2 times, it can pay off all of its liabilities 2 times. Then we have Royal Dutch 1.89, ConocoPhillips almost 2, Pembina Pipeline 2.02, and Imperial Oil 2.4. So this is quite amazing to see that Imperial Oil, being the smallest company, is actually handling its assets and increasing the assets quite nicely as compared to the other other four huge players. And Chevron and Imperial Oil are having the best ratio. But guys, above 1.5 or above 1 is good, and these are above 1.5. So I would say all are in a better position when it comes to paying off its long-term liabilities as well. So total stockholders equity, like I have discussed this before in my previous videos, this number should be increasing when you compare with the previous years. That means the rate at which the assets of the company is increasing, it's higher than the rate of increase in its liabilities. So these are the numbers. I will not go through the numbers, but I have taken the trailing 12-month period for the stockholders equity, and you can compare it with the previous year. So I would say that it is increasing for all the companies which is in this list. Then we go to the current ratio. The current ratio is just the ratio of total current assets by total current liabilities. So it's the same as total assets versus total liabilities, but just taking total current assets by total current liabilities. So the liabilities and the assets which are for the coming 12 months period. So as we can see, for Chevron it's 1.1, for ExxonMobil is 0.8, for Royal Dutch is 1.2, for ConocoPhillips is 2.4, for Pembina Pipeline is 0.7, and for Imperial Oil is 1.4. I have a note right here. This means that ExxonMobil, according to me, is a risky business. Now, why I say this? Because like I have mentioned before, at this time, we must consider the coming 12 months liabilities, because this is the time when these companies will be facing the challenges, and this is a time when they have to survive, go through this difficult times, and that's why the coming 12-month liabilities is important when we are seeing at the company's finances. So that's why I would say Imperial Oil in this case becomes a bit of risky business. But anyways, one ratio is never the deciding factor, so we will go through the other ratios as well. But when it comes to the current liabilities, yes, ExxonMobil is one of the riskiest amongst all, and Pembina Pipeline as well. So these two have the lowest ratios, and these are a bit of risky business according to me. But if we see here, ConocoPhillips is 2.4 and Chevron 1.1 and Imperial 1.4. So amongst them, ConocoPhillips is one of the most stable companies right here, and with the margins really good, and with the current ratio as well as with the total assets versus total liability ratio. So for now, I would say that till now this company has proven to be the most stable amongst all. Or let's say a more safe investment. So then we go to debt to equity ratio. So just to explain you guys, debt to equity ratio, this is Investopedia. I just opened up Investopedia and you can see it here, the key points, what debt to equity ratio actually means. Debt to equity ratio compares a company's total liabilities to its shareholder equity and can be used to evaluate how much leverage a company is using. That means how much debt a company is using in order to raise capital. So investors will often modify the debt to equity ratio to focus on long-term debt only because the risk in long-term liabilities are different than for short-term debt and payables, like I have told you before. In this case, debt to equity ratio will also be considering long-term debts. So just to summarize, the higher the debt to equity ratio, that means the higher risk the business is at. So debt to equity ratio for Chevron is 22.32, for ExxonMobil is 31.58, for Royal Dutch is 51.84. So we are talking here about long-term debt and not short-term debt in this case. And ConocoPhillips is 47.7, Pembina is 6.651, and Imperial Oil is 23.08. In this case, Imperial Oil is one of the safest bet when it's coming to debt to equity ratio, and especially the long-term debts, which we have already seen it here. So in this case, Imperial Oil wins the race. Now let's move on to our next ratio, which is price to book value. Now this is also a really important figure for many analysts, because this will tell us, and in one of the ways, that if the company is undervalued or not. So when this ratio is less than 1, that means you're acquiring the business under its asset value. So for Chevron it's 1.19, for ExxonMobil is 1.04. These are above its asset value. That means you're acquiring this business above the asset value, which is not recommended by analysts. Royal Dutch is below 1, which is good. That means the company is undervalued at this time. ConocoPhillips is at 1.5, Pembina Pipeline 1.36, and Imperial Oil 1.67. This means that Imperial Oil is currently at a really undervalued price. But guys, remember one thing, that price to book value has long-term assets, so you have to remove the intangible assets from those long-term assets, because actually it doesn't make sense to take intangible assets into this ratio, according to me, or according to my opinion, because the intangible assets are the assets which you can actually not liquidify. So they are non-physical assets, as Warren Buffett says. So I have not taken the intangible assets into consideration, and with that I see that Imperial Oil is the most undervalued company at this time, and it means that it is a good buy according to just price to book value. Okay, not I have not given my final decision or my final verdict, but according to this value, yes, Imperial Oil is the cheapest. So price to earnings ratio, as we have discussed before, what price to earnings ratio actually means. So price to earnings ratio, I have also mentioned this in my previous videos, So just to summarize it in layman's language, if I would have to explain price to earnings ratio, I would say that, for example, if I would acquire Chevron as a complete business, and guys, that's the way how I see my stocks, and that's the way I'm following how to choose my stocks, and this is the way how Warren Buffett does it. So I see a stock as a whole business, so that's why I'm always considering its fundamentals. And so, for example, if I want to invest in this stock, I will look at its complete business, and I would consider this as a that as if I'm acquiring this stock with its whole business, so I'm acquiring the whole company. So in this case, for example, if PE ratio is 43.93, that simply means that when I will buy this company, I would start getting the return on in my investment after 43.9 years. That's all. So in this case, Chevron is the highest. ExxonMobil is 15.57. That means I will start getting my return on investment after 15 years or so. Royal Dutch 13 years or 13.18, ConocoPhillips 13.24, Pembina Pipeline 13.7, and Imperial Oil again 9.34. So this is the lowest. That means Imperial Oil is selling at this moment at a cheaper price. So if you want to see price to earnings ratio in another way, it is usually higher because also the investors think that this company is going to make or is going to make profits, or it's going to progress in future, and that's why the PE ratio is higher, because the future success is already baked into the price of the stock. Personally, I believe that any PE ratio below 25 is a good PE ratio, and I am comfortable with buying that company. Of course, when the P ratio is high, then I do another type of analysis which we have seen in my last video with Vata, which you can see in the iCard. Anyways, so here, as you see, Chevron has the highest PE ratio. That means it is currently really overvalued. And that is actually because the 2019 quarter 4 analysis and the financials for Chevron were quite good, really good. But anyways, it's still high, and I'm not comfortable buying Chevron at this PE ratio. And ExxonMobil 15.57. So the rest are lower than 2025. So it's okay for me. But the lowest is Imperial Oil once again. So these two factors are quite telling me or shouting that Imperial Oil is actually at a really undervalued price right now. Okay, guys, so we are heading closer to our final ranking. But before that, we must, of course, check the cash flow statement as well. And in the cash flow statement, I jot down two important figures, which I think in this case is important to notice. The two important figures are net cash by operating activities and free cash flow. So net cash by operating activities should always be positive and should be increasing year by year. It simply means that the operations of this company are actually making profit, and of course should be positive in number. So in this case, if we compare the net cash by operating activities with the companies, so we see that Chevron is 26, sitting at 26.97 billion, Exxon Mobil 27 billion, Royal Dutch 48 billion, ConocoPhillips 10.3 billion, Pembina 2.3 billion, and Imperial Oil 3.84 billion. And now moving on to free cash flow. So free cash flow is the cash at the end of the day which the company has, and it can do anything with it. So in this case, free cash flow for Chevron is 12.683 billion, for ExxonMobil 2.54, which is quite less if we compare the valuation of this company compared to its valuation. The free cash flow is quite less. But anyways, Royal Dutch is at 26 billion, ConocoPhillips 3.6 billion, Pembina Pipeline 560 million only, which is not so good, and Imperial Oil 2.34 billion. Now guys, this is what I like about Imperial Oil, because just see at their margins, they are quite low, even the lowest, and still with those margins at the end of the day they have acquired much higher position when it comes to free cash flow, much higher than Pembina Pipeline with amazing margins. So these numbers, these ratios are actually making or influencing my decision at this moment towards Imperial Oil. At the last, I would like to cover the dividend yield. which I know that most of you guys are curious about. But at this time, guys, like I have told you before, that the cash position of these companies might go down and they would have to cut on their dividends. And honestly, I would never recommend to buy a company just on for its dividends. I always recommend to buy a whole business, seeing its fundamentals, seeing its financial stability. And for me, and that's just my opinion, for me, dividend is just an extra bonus coming with the company. But anyways, for the guys out there who are interested in the dividends, so Imperial Oil is giving a 4.08%, Pembina 7.16, ConocoPhillips 3.84, Royal Dutch 9.68, ExxonMobil 7.9, and Chevron 5.61%. So Royal Dutch is of course giving the most highest dividend yield rate. And yes, so if you're interested in buying a big company, which is actually Royal Dutch, so it's one of the biggest amongst the all, and if you want a good dividend yield rate, then yes, Royal Dutch, why not? So anyways, so this winds up our financial analysis for all these 6 companies, which I think are good to be noticed, or which can actually survive and weather this storm. And these are my 6 favorite out of the lot. And so let's rank them according to the analysis which we have done. Okay, so here's my final ranking according to all the analysis what we just saw. I would rank Imperial Oil as the first company. Then I would say ConocoPhillips at rank 2. Then I would rank Royal Dutch at 3. Then Chevron at rank 4. ExxonMobil at rank 5, and at the last I would say Pembina Pipeline. Now I would have considered Chevron at rank 2 if I would have seen or just considered the Q4 statements of 2019 for Chevron. They were quite amazing, but after looking at the financials of the first quarter of 2020, Chevron for me has come down lower in the ranking.
And that concludes our analysis. So just to let you guys know that if I would have to choose one oil production stock, I would go for Imperial Oil. And actually I already have purchased Imperial Oil, and this is, yes, so this is my choice. This would be my choice, but I don't want to affect you guys with my choice. Do your own research. Check these stocks, and I hope these analyses are really helping you guys out to ease up that process for you guys and you're enjoying this. And if you are really enjoying this content, then don't forget to hit that like button. Don't forget to hit that subscribe button. Yeah, keep hitting every button which is out there, okay, except the dislike button. And yeah, and also don't forget to hit that notification bell, because then you will get to know my latest videos. I'm not that famous, and I know that you might not be so curious about my videos, but if you are, then just hit that bell icon, and that's all. So that's all for today, guys, and I hope you are really enjoying your time with your families, your friends, with your loved ones. So stay happy, stay safe, and see you in the next one. Ciao. Hey everyone, welcome back to my channel once again. Today's topic would be a stock which I recently added to my portfolio last week on Friday, and I will walk you through the detailed analysis on this stock and how one factor is never a deciding factor for me or for any investor out there who is going deeper into analysis. And in this example, that one factor would be price to earnings ratio. So without further ado, let's dive into it.
So the company which we are going to talk about today is a German company, Warta AG. This is the official website of Warta AG. Now, what is this company all about? So Warta AG is a group. That means it operates through its subsidiaries, which are Warta Microbattery GmbH and Warta Storage GmbH. So what they are dealing with, so these are the business segments which are dealing with microbatteries and power and energy. So Warta Microbattery is dealing with microbatteries, and Warta Storage GmbH is dealing with power and energy sector. And Warta Microbattery GmbH is already an innovation leader in the field of microbatteries. And just to clarify this, that Vata's most of the revenue is coming from this business, micro batteries. So they are the market leaders of lithium, for lithium batteries as well. So just to show you guys, so these are some of the solutions which Vata is providing at the moment: micro batteries and solutions, and household batteries, which consist of further healthcare, entertainment solutions, consumer batteries, and energy and storage. So this segment is the Vata micro battery GmbH. In Germany it's GmbH, and I'm saying GmbH because in German we call it as GmbH, not GmbH. So, and the other sector is this one right here, Vata Storage GmbH. And these are some of the applications where the micro batteries are used, especially the hearing aids. Vata has a really good business in medical industry and especially for hearing aids. And this is the other segment, power and energy, and this is working the same way like solar panels. So that means the energy is collected throughout the day and then it is converted to electricity or power for your home or even commercial factories and commercial places. So energy on demand for private households and commercial applications. So like I said, it is the market leader for lithium-ion batteries in wearable segments and especially in the hearables segment. And it has 5 production manufacturing facilities in Europe, Asia, as well as in Central Asia. Okay, so that was a short introduction about the company which we are talking about today, Vata AG. It belongs to electrical energy sector. So let's have a quick look at the summary of the Vata AG at Yahoo Finance. So the market capital is currently sitting at 3.634 billion and the 52-week range is from 42 euros to the highest peak 128 euros. So this is one of the other reasons why I chose Vata AG. So I bought this company on last Thursday at around 75 euros and that was still at around 50% discount. And yes guys, I can see that the PE ratio is quite high, but we will get onto this later in this video. So when I bought this company, it was still high, it was around 65, the PE ratio was around 65. So yes, I will clarify this later in the video why I still chose this. So the other thing which I really like about this company and which I usually check is the financials. So if you see here, the financial chart annually, it is growing like really steadily. So you see the revenue is growing steadily, but the other thing which is really attractive about this company is that the earnings is almost double every year. So if you see here, the earnings are increasing by 90% every year. So this is one of the best things what I really liked about this company, Vata AG. And now let's quickly dive into the financials. So we go to the financials and as usual we will check the income statement. I will not go into the details, so we will just quickly check the numbers in order not to make this video too long. So the latest financial report says the total revenue is around 487 million euros. Gross profit is around 314 million euros. So as you see here, this is what you should always check, the trend. The total revenue is increasing, but also the gross profit is steadily increasing. Now the operating expenses is around 216 euros and operating income is around 97 million euros. So yes, the total operating expenses are increasing, but also the operating income is increasing. So if you see here that the operating income was almost doubled from 2018 to 2019, which is quite a good thing, which means they are really dealing with their operating costs quite nicely. The next is the net income. The net income is positive. That means the company is making profit. And let's move on to the balance sheet. So let's quickly check the balance sheet. So the first number which is worth checking here, it's the total current assets, which is actually really steadily increasing over the years. And the next number which is to be checked is the total non-current assets, which gives us a total of 668 million euros. So total current assets plus total non-current assets gives us a number of total assets. So the total non-current assets means the assets which they can not liquidify in the coming 12 months. These are long-term assets. So like property or plant equipment, that means they are not planning to liquidify this in the coming 12 months. Okay, and then we move on to the liabilities. So we check here the liabilities. So the current liabilities, that means the company owes in the coming 12 months is around 165 million euros and the total liabilities is around 254 million euros. Now guys, this is what I call a really strong balance sheet. What I mean by this is that if now at this moment of time, if the company's revenue stops completely, that means there is no income and there is no profit, and it has to pay its current liabilities, which is 165, that means the liabilities which the company owes in the coming 12 months, it can pay off not just this amount, it can pay off actually all its liabilities, short term and long term, by just liquidifying its current assets. This is huge. That means they won't even touch the long-term assets and they can pay off all its liabilities with just the current assets, and still they would be left with some assets. And this is, according to me, is a really stable company, and also means that this company is not going out of business anytime soon. So the other numbers which are worth checking right here for this company especially is stockholders equity, further which is further divided into common stock and retained earnings. So common stock means that they have been investing money in stock repurchase. And actually, I'm not a big fan of this practice, but for such a company with strong balance sheet, this is quite justified. And also retained earnings. Now, this is a bonus for me. That means they have been paying their dividends quite steadily, as you can see here. So this is the amount of the money which is left off after paying the dividends. So this comes with a bonus. To be honest, I don't buy a company based on its dividend yield. I never do that, but if it's a good company with strong balance sheet, then it's a bonus for me. So the next number which is worth checking on the balance sheet is the stockholders equity. And as we saw that the current assets are really increasing for this company year by year, and that also means that the stockholders equity must be increasing. This number right here is actually balancing out the whole balance sheet. So it simply means the total assets minus the total liabilities, and that means the company's assets, if this number is increasing, that means the company's assets is increasing as compared to its liabilities. So this number right here should always be increasing, and you must definitely check that. And it's increasing really nicely, as you can see. So this is quite good for this company. So now let's go on to the cash flow statement. Okay, so the first number which needs to be checked right here is the net cash provided by the operating activities, and this number should be increasing first of all, and should be of course positive, because this means that the operations are actually good and the actual operations are making profit. So the next is the cash flow from investing activities, and if you see here, this number is in negative. Okay, we don't have the expenses here, but let's see for 2019 quarter 4. And if you see this number negative, this doesn't mean that this is a bad thing. That means they are investing the money. If you see here, they are investing the money in, for example, in property or plants. So this means that they are investing the money in their own company. So this is good because this will actually lead to increase in the number of assets. Okay, so the last thing which we need to check is the net free cash flow. So free cash flow in the trailing 12-month period is around 24 million euros, which is good. That means they can do anything, whatever they want with this cash. Okay, so after checking all the numbers from the balance sheet, I have summarized all the margins and the numbers which I usually consider. So let's quickly check all of them. So gross margin percentage is around 67%, and guys, this is really high. An average good gross margin is considered to be around 30%, and this is 67%, which is amazing. Now operating margin percentage 20% is also really good. That means the company is able to save around 20% of the profit after all its operating expenses. Now EBITDA margin we have already discussed in our previous video. Average EBITDA margin in electrical industry is around 20 to 25%, and you can see it's 184%. Now why it's so high? It's because of its earnings. So the earnings have almost doubled every year, and also in 2019 it has doubled, and it's been around 98 to 99%, which you will also see further in the video. So that's the reason why the EBITDA margin, earnings before income tax, depreciation and amortization, is really high, and that's why I like this company. Current ratio is around 2.3. Now this means it's the ratio of total assets by total liabilities. That means even if the revenue of the company is stopped completely, the company can pay all of its liabilities 2 times over. Book value, so just current ratio, you should always see that the current ratio must be higher than 1. 2.3 is amazing. So that means this company is not going anywhere anytime soon. Book value is positive, and total stockholder equity is also really high. The both number shows almost the same thing, that the rate of the assets of this company is increasing higher as compared to the rate of its liabilities. Now return on investment capital means that the company invested some money and on capital or invested money in its own business and were able to generate profit of around 21.25%. Anything above 10% is considered really good for a company. That means the company knows how to invest money to generate profit. Price to earnings ratio is 71.4, and we will come soon on this number, why it's so high and why I still consider this stock, though the price to earnings ratio is really high now. Typically, the price to earnings ratio which I consider, or I say it's good to invest in a company, is around 20, but this is a perfect example to show you guys that price to earnings ratio or any one number or any one ratio is never enough or never should be the only number or ratio for you to decide to invest in the company or not, or for any smart investor. So the discount means that how at what discount I actually bought this company, so discount on the stock price as compared to its peak value. Okay, so now let's check the numbers game. So let's see why I actually invested in this company. So yes, the balance sheet was quite strong enough, and that was just the fundamental analysis. But now we will actually see that despite of this company having a high PE ratio, which is usually considered by many investors, but it also means if it's really high, that means the company is supposed to be overvalued because the price as respect to its earnings is quite high. But still, why I considered this company, and we will see it right here. So I purchased, like I said before, I purchased this company at last Friday, and it was sitting at 75 euros at that time, and the float value was 16.48 million. Now what float value actually is, it is just the outstanding shares outside in the market. Float value you can easily see from statistics. Go to statistics and just scroll down and you will see it right here. This is the float value, which is 16.48 million, and that's where I took this value from. So that means we can calculate the market cap at which I actually purchased this share, which is simply the purchase price multiplied by the float value, and this gives me a market cap of 1.23 billion euros. Now the average PE ratio for electrical industry is 16.9, and this value I have got from Yahoo Finance, and you see that 16.9 is the average PE ratio for the electrical industry. So I took this PE ratio because, like I said, this PE ratio is considerably good and believable according to me. So that's what I do when the PE ratio for any company is quite high, and to check if that PE ratio is actually justified. So in this case, I took a believable PE ratio with which is 16.9, which is below 20 or 25, which is quite good PE ratio for any industry, and this gives me a reflected earnings. Reflected earnings is just market capitalization, which I got from this previous calculation divided by the average PE ratio, and this gives me a reflected future earnings of 73 million euros. Now what this means, this simply means that when I bought this company at 75 euros at a market cap of 1.23 billion euros, I considered that this company will surely in future make above or somewhere around 73 million euros in earnings. And if this company is successful in making any figure around 73 million or above, then my purchase price is justified and I will surely make a profit. This is one of the ways how I decide my stock, especially for example in this case when the PE ratio was higher. Now why I believe that this reflected earnings will be crossed for sure. So let's check that out. So as you can see here, I took this value from here. 50.39 million earnings was the earnings in 2019. And if you see here, 2018 was 25.26 and 2017 was 13.27 million euros. Now what this means? This means that the earnings has been increasing steadily. For example, from 2016 to 2017, it was around 40% or 50% increase. And from 2017 to 2018, it was around 90%. And 2018 to 2019, it was an increase of 98%. So this means if the revenue keeps increasing in this manner, the earnings is probably going to increase in 2020 as well, around 90% or 95% or even more. So let's check the revenue, what the revenue would look like in 2020 for Wata. So as you saw that previously the earnings had been increasing steadily by 90% or so, minimum 90%. So that earnings are justified when of course the revenue is also increasing by an equivalent amount of percent or somewhere same as in the history or the past years. So let's check it out. And as you can see here, the group revenue for Q1 2020 was 198.5 million euros for Wata. So if we calculate this, so let's say 198.5 million euros for 4 quarters gives us a revenue of 794 for the whole year 2020 for Wata. But okay, so let's say this is overestimated because in Q2 most of the companies in Germany were closed, and Wata was, let's say Wata was also closed, and it could not produce in 2 months of Q2, and it could not make as much as profit as Q1. So in this case, what we will do, we will take, let's say, the minimum revenue for Q1 in 2019. So from annually, I switched to quarterly. So here we will see that these are the quarterly revenue of year 2019. And let's take the minimum revenue. Now, this is also really underestimated, but I always choose a stock with the worst case scenario. So let's say this is what it will make in Q2. 76.97 million euros, and let's say in Q3 it also didn't do well. It took some time to increase its production, and it will make around 86.19 million euros. And in Q4, let's say it was same as 2019, 120.97 million euros. Now guys, this is a really underestimated revenue. If we compare the revenue which it made in 2020 first quarter, this is really an underestimation. But like I said, always take the numbers considering a worst case scenario, and if your calculations passes the worst case scenario as compared to the current scenario, then that stock is actually a really good buy. So if we take all these numbers, we get a number of 482 million euros. That means if we consider this number plus the Q1 198.2 million euros, we get the total revenue of 2020 as 482 million euros. Now we switch back to the annual financials, and we see that the revenue has increased. So from 2017 to 2018, this is a 12% increase in revenue. And even with 12% of increase in revenue, the earnings increased by 90%. Okay. And now from 2018 to 2019, so the revenue increased by 33%. And even with this revenue increase, they made around 99% more in earnings in 2019. So if I say 482 million they make in 2020, that is an increase in revenue by 31%. And you see the history, even if the revenue is increased by 20 to 31%, that means they will surely make earnings of around 90%, because we are assuming that the operational margin will remain about 20% or 25%, because in these 3 years the operational margin was really good. It was around 20 to 25%. That means the operating activities costs will be as same or will be indirectly proportional to the revenue. So that means the revenue is increasing, so operational cost will increase, yes, for sure, but not with a higher margin. The margin will remain the same. Okay, the numbers will increase for sure, but the margins remains the same. So in that case, it means that 90% of increase in earnings will result in an earnings of 95 million euros. Okay, but okay, like I said, let's take the worst case scenario. So let's say that we take the increase in percentage of earnings from 2016 to 2017, which is a really high underestimated increase of earnings if we see the success of Wata with Q1 earnings. But anyways, so let's take the worst case scenario. So worst case scenario was that from 2016 to 2017, the earnings increased by just 50%. So even if we take 50% increase in the earnings from 2019 to 2070, it still makes earnings of 75 million euros. Okay, so let's get back to our numbers game. So this is why I really liked this company and thought it of as a good investment. So you see that even
even with the worst case scenario, which is just 40 to 50% increment in its earnings, it will still be able to make 70 to 75 million euros in 2020. And guys, literally you saw that this is the worst case scenario. And even with this scenario, the reflected earnings which we calculated was around 73 million euros, and the real earnings could be just around this reflected earnings, and I'm pretty sure this Varta would be able to make higher than 73 million euros hands down. And this is how I made my decision to buy this company, and still the purchase price was at 75 euros, and the 52-week high was 128 euros, so it was around at 70% discount. And that's when I really thought that yeah, it has a huge margin to grow when it comes to its stock price, and of course it has a huge margin to grow as well when it comes to its earnings. So despite of the company having a high PE ratio, I still bought this. Yes, you should always compare the PE ratio with its peer or competitors, and in this case the PE ratio for average PE ratio for electrical industry was quite low, and the PE ratio for Varta when the time I bought this was around 65, which is quite high. But this is what I want to tell you, that a high PE ratio doesn't always means that it's a bad buy. Yes, in most of the cases it might be it really might be overvalued, and so in such cases when the PE ratio is out of my comfort zone, especially like in this case, so I do such calculations, and this helps me to actually see that no, the stock is not so overvalued, and even if the PE ratio is high, then it is actually justified. So in this case it is justified, guys. So just with its current assets, it can pay off all its liabilities, all its debts, the long-term or the short-term debts, doesn't matter, and this is why it is justified. And also the earnings are increasing, so the earnings were almost double, as we saw, 90% to 98% increment, and that's why the PE ratio is quite high, because it's inversely proportional to the earnings of the company. And this also means that the investor actually know that this company is going to make huge profits in the future, so the profit in the future is already baked in to the company's purchase price, and that's why the PE ratio is high. But in this case it is justified, and also it doesn't mean that it is an overvalued company, and I have no problems to hold the stock for a long time. Anyways, I always consider long-term investment as the most effective way of investing.
And I rest my case. Yeah guys, that's it. That's all for today. I really hope that it was easy to understand how I decided and how I chose this stock. So I have put the numbers out there, and I hope this would make easy for you also to make some analysis of your own. And I'm here to help you guys, and if you have any questions, or if you have any comments, or if you want to say something, just please use the comment section below and I will answer them for sure. Apart from that, if you really liked the video, then please hit that like button. It really helps me. You don't even realize how much it helps me. And don't forget to subscribe and hit that bell icon. I never mentioned this in my previous videos, but yes, because when I will make a new video, you will get a notification, and in that case you will get to see the content which I made, if it's really important or if it's helpful for you guys. So till then, keep investing, stay safe, stay healthy, and peace. Peace and ciao.